Thanks very much, and welcome back. This program each week presented by Chuck Malamut. He's here, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck, I did a lot of homework for your show today.
Good morning, Harry.
Good morning.
In light of all the political shenanigans, you have time for this.
Yeah, I do. And I know that October was the best October in 4 years. The Dow was up 8.4%. The S&P 500 up 8.3%. The NASDAQ up 9.4%. And the Dow, ladies and gentlemen, back in the black for 2015, I think based on the woeful GDP, which I don't know if did you hear any of my early part of the program today, Chuck?
I did not, Harry.
I did such a great narrative on 7 years of President Roosevelt, meaning FDR, not Teddy, during the Great Depression, and this president, and the fact that even during the Great Depression, we had several years that were over 3% GDP. We have never had beyond 2%, and I think that's almost guaranteed for the rest of for this year, because which will make 7 straight years, because we would have to grow by about 6% in the fourth quarter for us to be at 3% for the year. And I think we both agree, Chuck, that's not going to happen.
Yeah, but Harry, there is some good news with respect to GDP. That if you take a look at the quarter over quarter, the initial estimate of third quarter is about 1.5%. So
where's the good news?
So the growth. I mean, the headline does not send a positive message about the health of the U.S. economy, but if you look at some key underlying areas with what makes up GDP, most notably the consumer, and we talked about this last week, and we'll talk about it a little bit today. We are seeing growth in the consumer side. When you look at consumption, that makes up part of GDP. Government, business inventory, residential investment, business investment, net exports. I mean, and when you sort of break it apart, the consumer the consumption is up over 2.2%. Inventories were down for the quarter. Net exports were marginally flat, slightly positive. Same thing for residential investment. So there is, what I'll call a ray of hope as you kind of talk about, GDP. And I do agree with you that it would be incredible if we had an opportunity to take the handcuffs off and operate.
And that's what I'm speaking about.
And operate our country the way the country needs to be operated in. And
how have the financial markets, this was my 6 o'clock hour piece of my monologue, how have they been so resilient through awful, awful strategies of this administration for 7 years to deliver these kinds of results? I think it's amazing, actually.
Well, Harry, I think to generally answer that, if you take a look at, and we've talked about this, it seems like every quarter, what a lot of companies continue to do is either get to their top line or slightly miss, and then they end up reducing their costs. Either it's reduction of payroll or inventory or whatever, or actually net interest expense, because rates obviously have been low for quite some time. They're able to squeeze it and get it to the bottom line, so you either make that bottom line number or slightly higher, slightly lower. So that has been instrumental. And then the last piece is the continual mergers and acquisitions. And if you take a look, it's just so hard to believe that just about 60 days ago, when we were at sort of the third week of August, and you sat and you watched in total disbelief as the market goes through what I'll call nothing short of a meltdown. And it did cause, across not only individual investors but also institutional investors, particularly hedge funds, a fair amount of angst. And, imagine for a minute if you had sold your positions in the middle of that and, you temporarily felt better because, you've either locked down your gain or you've locked down your loss depending upon your entry point and the amount of time you owned a particular asset. And now look at what you've accomplished. You gave up the biggest month. I mean, you think about, traditionally speaking, October is just an awful month in the markets. Remember the crash of '87?
Sure.
The multiple, what I'll call either mini crashes or corrections. A lot of that is, it takes place during the month of October. So if you were astute enough to maybe do the proper asset allocation, so think about this for a minute. If you did the asset allocation at the end of the September quarter, it would have probably told you to increase your equity exposure because you had just a lousy August, not a very good September, and you would have been rewarded at least temporarily for the month of October with a rate of return of 7 to 9%. We'll call
Let me jump in because this is another area that you've been extremely intellectually honest about, Chuck. In the midst of all the good news, I can't understand why. Although I think it goes back to the opening comment that I made during your show, Chuck, and the comment that I made a few hours ago about the national executive branch leadership, because my corner gas station, which is always a lot more expensive than others, it's $1.79 right now for a gallon of gasoline. There should be so much discretionary additional spending available, income available, but it's not happening. And I'm going to tie it into this October wonderful news that we have about 8.4, 8.3, 9.4, all the indices way up, way up. But the consumer companies are lagging. Why? And isn't it because there is not confidence of the consumer to spend?
Well, Harry, I'm going to disagree with you a little bit here because if you take a look at your, if you take the S&P 500, and it's made up of multiple sectors, as you know, energy, utilities, financials, consumer staples, technology. The best performing sector in the S&P 500 year to date is consumer discretionary.
Yeah, but I'm talking about October.
No,
October,
I'm saying, but
wait.
Like,
Like I told you, I did a lot of homework. Walmart, Nordstrom, Gap, Best Buy, food chains, Chipotle, Yum Brands, Dunkin' Brands, Buffalo Wild Wings. All
but Harry,
missed.
but 1 month or 1 quarter doesn't, it does not, tell the tale of the market. I mean, there are certain companies that did miss, and there are certain companies that
they all missed. But what I'm saying is, we were talking about October being the best October in 4 years, but the consumer companies did not. They lagged. And I'm a layperson, but I'm going to say it. They lagged because there's not confidence in this government, and people don't know if they're going to have their job, so people are not spending as freely as they would.
The good news about government is that it has been very quiet coming out of Washington for the most part. If you think about, where we were either 6 months or a year ago, there's not a lot of noise and there's not a lot of interference at this point in time. The projections are, as we talked about, as we ramp up and get to Christmas, what's going to happen with respect to the consumer.
And by the way, those results were not just October.
No, those results are the prior quarter. Right, they're the
Yeah.
quarter, ending the third quarter.
Yes.
So, what we think will be happening, according to the most recent Gallup survey that was performed, that this could be, one of the best Christmases that we've had since we go back to 2007. Consumers at this point in time don't seem to be terribly concerned about what's happening in China. And you think about, the headline risk that was out there in August and September. We are seeing a fair amount of widening credit spreads as the Fed is discussing the potential rate hike, and you've had a lot of liquidity in the fixed income markets. That continues, Harry. So the consumer doesn't seem to be terribly worried about that right now, and that's a good sign. So
why are the consumer companies down then?
I think what happened was, Harry, if you take a look at the third quarter, it wasn't particularly good for a lot of companies.
But in particular, consumer.
But consumer discretionary, one quarter does not make a market. I think we've all come to that conclusion. Now, can Walmart, take itself off the mat, so to speak, and recover? Perfect case and example. The last quarterly results that came from, and I don't like to use an individual company, but I will, is Disney. There was a small. I think they either made it or slightly missed, but there was
remember, they made the one and missed the other.
There was a lot of noise about ESPN.
Yeah.
And it drove the entire media sector down.
Yeah, I thought that was so disproportionate to reality.
And now if you take a look at Disney today, it's recovered all of those losses and actually year to date is significantly in the green. So
how come? Do you have an? I don't expect you to have a finite, perfect explanation, but why does something that should not have been as disproportionate wind up being so punitive? Because that was I saw that they made their number. There was this other number that wasn't right.
Wait, how's the old expression go? Where there's smoke, there's fire. Isn't that how?
Yes.
And
but would that
what
be
happens?
Every company?
No, but what happens is, oftentimes, unfortunately, and it happens more on the institutional side than the retail side. Sell first, ask questions later. And so when you see those, it kind of scroll across the tape. You see the earnings and you see the comments coming as a follow up to the earnings. You say, okay, well, you're talking about ESPN and what happened with ESPN. So what's going to happen in the future? And yeah, you're absolutely right, Harry. That whole sector suffered immeasurably as a result of what happened. So that's why it's very, very important that you continue to diversify your holdings. Unfortunately, there's just too many individual retail investors that fall in love with particular equities or industries and equities within those industries, and they ignore the rest of the marketplace. And that's just, it's not today, and it's not tomorrow, and it's not yesterday. It's just happened for years. And I think as an astute investor, what they need to do is they need to understand not only what happens locally, but what happens globally.
Excellent analysis, Chuck. Very, very well done. So we're going to get our first break in. So in terms of how the market's performed, excellent beginning. We talked a little bit even about corporate earnings by accident sort of there as a part of that. We'll get into some more of the consumer and holiday spending, the budget, the Fed, and anything else that Chuck has as we continue in just a few minutes. Chuck Malamut, the official financial advisor to Hurley in the Morning, our 25th year together here on Hurley in the Morning, WPG Talk Radio 1450, and to reach Chuck and his team, the Malamut Group. Chuck is managing director and leader, of course, of his team. 609-383-2010, the number to reach Chuck. Welcome back, Chuck Malamut. Yours truly, Hurley in the Morning. Chuck, time is yours.
So Harry, usually we don't focus on an individual day within the marketplace, but I think it would be remiss if we didn't spend a few minutes and talk about what happened yesterday, which was the first trading day of November. Uh-huh. We have spent a fair amount of anxious times this year on the plus side, but more on the minus side. And if I were to poll all of your listeners, how many of them would say, well, the major indices as you have identified are now positive for the year? What do you think that percentage would be? Very
low. Shockingly low.
And
I'm surprised.
So if you take a look at what happened yesterday, I think yesterday was a very, very good sign within the marketplace. It was the first time that we closed above 2,100 on the S&P since August, since that dreadful day, August the 24th. The index itself is now about 1% below the all-time high that we had made earlier this year. If you polled your listeners, they would Harry, they look at you like you have three heads. The S&P from the time we put that low in and we retested it back in September is now up over 12%, and that was just over a month ago. In August, as we kind of chatted about before, not only here domestically but also internationally, we were all cued into China and what was happening as concerns around the world about the growth or the lack of growth in China. So I think that we've had, the weak manufacturing data that we've kind of chatted about a few minutes ago with respect to, GDP. Now all of a sudden things are starting to look a little bit better. And last week, Harry, we had a couple reports. The October ISM manufacturing number came in, and the Census Bureau September construction spending report both came in ahead of expectations. So we are seeing a fair amount of M&A, merger and acquisition activity. Every day. Not every day. You wake up on Monday, you're going to see a deal or two, and that's obviously positive. And several deals, mega deals have been announced, over just the last couple of weeks. So that kind of turns the table back to the Fed, because the Fed met last week, and what happened?
They didn't raise rates, but they hinted towards sort of the possibility that maybe December, but they were going to wait to see the jobs report that's going to be coming out.
So if you take a look at the Fed future, right? If you take a look at the Fed future market, it kind of, that's where they bet on what's going to happen with interest rates. Prior to the meeting and the announcements with respect to the two reports I identified a few seconds ago, there was a 35% probability that the Fed was going to make a move on that December 16th meeting. Now that probability is a little bit higher than 50%. So you're going to continue to get a fair amount of volatility in the fixed income markets
Chuck, let me go back to that date. I thought their language looked more like it would be less likely than even money that there would be an actual rate increase based on what they said. And I don't expect, and the numbers that I've been reading in advance, we're expecting very bad numbers on Friday.
Well, the market, again, the Fed looks at all the reports to come. So when you take a look at those two positive reports that came, all eyes are going to be on the jobs report.
But if we're expecting like 250,000 and it comes in at like 160, I can't imagine.
I think the number that, if I remember correctly, is 182,000
that they're expecting.
That is the consensus is for the month of October. When they report on Friday, the number comes in at 182,000. Payroll additions, during the month of October. So, that is obviously another number that the Fed looks at. And I think, as we kind of chatted about this on several occasions, after you look at the Fed minute meetings, they're not all walking in lockstep with respect to the decision. I'm convinced, and I think, Harry, you are too, and that it's time that we get started, and it would be great for savers, and I think it would ultimately, be very, very helpful long term with respect to economic growth to make a move with these interest rates.
I think it has to be done at some point. I don't think they're going to do it in December.
I would have told you that 2 weeks ago. I agree with you, but I'm probably a little more leaning to something happening in December for sure. First quarter of next year, particularly March.
Yeah,
that doesn't.
That I definitely see.
That doesn't preclude the Fed from coming on an off meeting date and just coming with a rate increase. But I think it's going to happen sooner than later for sure.
Now, the budget thing that happened, the markets didn't even sort of smile at that. But if we ever had the quote-unquote threat of a shutdown, the downside of that would probably be felt. This was kind of unprecedented over the past 7 years to have something actually, parts of it, not all of it, because there's not going to be a budget for 2017 yet, but parts of like the spending limits and ceiling and things like that, good for 2 years. We haven't had anything like that.
No, I mean,
ever.
So you think about it for a second. The fact that the budget deal, was accomplished and signed off by all parties, that should contribute to economic growth and stability over the next couple of years. So the fact that it is 2 years, and the deal they put in place was to raise the debt ceiling, increase federal spending, marks the end of a multi-year period, Harry, of having this austerity, with respect to the budget. So we think that the increase in spending could add anywhere from 0.1 to 0.2% to U.S. growth over the next year, which I think is, obviously takes another issue off the table, so to speak, and more importantly, hopefully we can begin to operate, as a country with taking the shackles off, so to speak.
Does it pretty much work that if something good happens, it gets very little credit for it? Almost like, hey, you're supposed to be good, you're supposed to be great. But if something bad happens, you get disproportionately sort of crushed. Is that sort of the slang rules of the game?
Yeah, you'll get this. You might get crushed a little bit depending upon what happens, with a particular company or an industry or a market. But as you made your statement, I'm sitting here and I'm smiling and I'm thinking about the distaste that I have to watch the news, whether it's local or national. And that 6 to 7, everybody used to come home, you watch the 6 o'clock news and you watch the 6:30 national news.
I don't know anybody that does that anymore.
I will tell you that
you couldn't pay me to do that.
Out of 365 days in a year, if I watched the entire 6 to 7 hour time slot, I would tell you at best it's 2 to 3 times a year.
We're at break time, and that's even more than I do it. I don't ever do it. 0. We're at break, but let me just feather this in. There's a reason for this. Because information is out so many hours before you even get to that time of the day. That's old news. They're not breaking any news. They're regurgitating, what people already know.
I'll agree with you on that, but Harry, I think the point that I was trying to make is not the speed and the way we get our news today compared to the way we got it years ago. Is the fact that what you mentioned before was you get punished for negative items, issues that happen within your company or within your country or your city. When was the last time you really saw, if you took that 1 hour of news, how much of that hour is actually dedicated to positive events?
Well, that's all,
and not negative events.
The expression, if it bleeds, it leads, didn't happen for no reason. Brief timeout, 31 minutes past the hour. Chuck Malamut continues, our official financial advisor to the Hurley in the Morning program. For 25 years, we have turned to Chuck. We unconditionally recommend that you turn to Chuck for all of your needs, your financial needs, and he will introduce to you his perfected concept of total asset management coupled with the all-important asset allocation. 609-383-2010 to reach Chuck and the Malamut Group at Morgan Stanley's Northfield office. Welcome back, Chuck Malamut, Hurley in the Morning. It's Chuck Malamut, Monday, Tuesdays in the 8 o'clock hour for all of your financial planning needs. 609-383-2010, the number to reach Chuck and his team, the Malamut Group at Morgan Stanley's Northfield office. Chuck, who would have thought at the rate that this year was going that we are literally, just sort of recast some of the earlier portions of your program, we're in positive territory in every indice, basically, the key indices, and this could wind up being a positive year.
Harry, if we had this, if we re-racked the tape and listened back as we retested the low in September, and I at that point in time was not terribly optimistic that we were going to get to our projections of 8%, roughly 8 to 10% in the markets. the fact that one of our chief strategists and they made this call not recently, but back when we retested the lows, S&P at 2,200. So if you're able to get to that 2,200 number versus where we are now, and you tack on the gains that we currently have, you're not that shy of the number that we chatted about. Now, we have to get a lot of things right, for that certainly to happen.
At a time of year that's usually pretty difficult to do that.
Well, fourth quarter, Harry, is usually a decent quarter. And again, not that I want to focus on the Fed per se, but I think a lot of us are looking in the financial markets with respect to the Fed. And if you take a look at the action within the market, the day they came with their announcement, because they did say, they mentioned that the next meeting, that being December, at a time of possible action. So equities initially dipped when that news came out, and then recovered, following the news, which we think is a pretty good sign for investors. Are now certainly prepared for higher rates. That's not the case as what happened, 60, 90 days ago.
I saw a September number, which even though we've been talking mostly about October, this fits in this discussion because it's the most recent numbers in terms of building, new homes and things like that, highway spending and other projects. This was the most since 2008, March of 2008. The September spending on building new homes, highways, and other projects, $1.09 trillion.
So, Harry, when you take that and you add that back into the consumer, and that's where we started the discussion today with respect to GDP, I think the fourth quarter, I think investors should be relatively pleased with the outcome, as evidenced so far. The first, not 1 month certainly does not make a quarter, but I don't think anyone is going to be unhappy unless they were on the short side of the market with respect to what happened in October across most indices. And you think about, I'll refer back to the Shanghai, which is the Chinese marketplace. If you remember that market shot up like a rocket ship, then came down. It was up over like 50%, then went down, and year to date is up about 6%. So, if we kind of flip the page here and chat just for a second with respect to earnings for the third quarter. For the third quarter. Most of the earnings that have come in now, Harry, have been, for the most part, we're in pretty good space. The problem that we have is, as you mentioned before, is the decrease in energy prices. I mean, with respect to, the energy-related companies. Now, if you take a look at energy, and as part of the S&P 500, year to date, it is the worst performing sector, down 12%.
So you get the downside of both. You get the downside that the costs have come down, and what that means, but we're not having the increase in the consumer spending.
Well, no, consumer. I mean, I think you're gonna be pleased with what happens with the consumer, what's happening with the consumer now, and what's going to happen with the consumer as you get to Christmas.
I agree with that.
And, so if you look at what's happening right now, 2/3 of the companies that have reported for the third quarter, those earnings are on pace for a slight decline of about 1%. Well, you throw up your arm and say, well, geez, that's not growth. But if you exclude energy, as part of that number, we would actually be up about 7%. So healthcare, consumer discretionary, technology, those particular sectors have shown a lot of strength. And I think what's really positive with respect to the markets, Harry, is that, if you take a look at healthcare, it was one of the best performing, if not the best performing sector within the S&P 500 until about 6 weeks ago. and then took somewhat of a shellacking, so to speak. But now there's renewed interest back in in that sector. And I think that's obviously very, very important with respect to the overall growth of the marketplace.
How do companies usually work out? I know this is probably a little bit hard to answer one way because it could vary. But you take like an HP that split into two companies, didn't they?
They did, yeah.
And I'm one of the monitors. The one that you're right in front of is an HP. One is not. My home printer in my office is an HP. I'm a customer, but they decided to take sort of the physical product portion of their business and put it in one company, and then they took their cloud services and they put it in another company. And for all that, how do you do 1.6% drop?
Well, I think, Harry, if you take a look at, I won't talk about a particular company.
Yeah, I understand.
But I think if you take a look at what happens with a case of an HP, you have a company going in two different directions. And so what they did here, what oftentimes happens, you split your company, and into one side of the ledger is going to have pretty substantial growth, and the other side potentially not. So I think that's what happened in that case. You see it. You see it a lot here. Take for instance, a look at in the casino industry. The proliferation of the introduction of the REITs, the real estate investment trusts, where you're pulling out certain of your properties and you're going to put them into a REIT, and then you have another part of the company that's going to be an operator. So it's not uncommon, and I think HP suffered for a lot of years, and now ultimately this could help right the ship for them.
I mean, it sounded sensible to me. You take sort of hard goods and soft goods.
Yeah, I mean, it's
you
not
separate them.
So, we'll know in, I think obviously got to give it a couple years, but you're going to know in a relatively short period of time if this was a successful transaction or not.
We got to get out of here real quick, Chuck, but let me ask you just to try to break down and describe how did things turn around when they were looking like they were heading south, and then quick they headed north very, very strong. What happened?
Harry, I don't think there's a particular panacea or solution as to what happened and why it happened. I think what happened was, and I'm pretty convinced that a lot of the activity was driven from computer-related software programs that go in, because the volume on those days was just remarkable. And I remember that I did hear you this morning as you were making negative remarks about that TV station that just ran the debate.
Yes.
And I think a little disingenuous that when the market was in the turmoil that it was, that they were running the 7 p.m. specials market in turmoil. And that kind of just all goes back to what we chatted about before, about that negative news bias.
Yep.
And I think that, it wrung out, if you say, okay, what happened? It wrung out a fair amount of the excesses. We knew China was having problems, so it was nothing new. It was something that had to be focused on. Their markets, and we can write books as to what happened and why it happened. But the good news is, you do need corrections like we went through if this market continues to make an upward bias. So I'm hoping as we get to the end of the year that our initial projection we're going to be able to make. It would be just a wonderful thing.
Now, your program has officially ended, so I'm going to make a statement now in the Hurley in the Morning program. Just imagine that Alphabet cable channel that you're referring to when the most normal person on that panel was a guy named Kramer, and his first name wasn't Cosmo. Kramer was the most normal thing on that panel. And I think that says everything, because that guy is Abby normal. That is just, I think, the best description that I can possibly give. You have been listening to Chuck Malamut. Chuck is our official financial advisor. Chuck brings this program every Tuesday morning in the 8 o'clock hour. And the information, the views, the opinions expressed during the program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of the broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation each week is for informational purposes only. And that's Morgan Stanley Smith Barney, member SIPC, Chuck Malamut and his team for all of your financial planning needs. 609-383-2010. They're located on New Road. That's Route 9 in Northfield. 609-383-2010. Chuck, you'll be here next week.
We will with Kurt. You have a wonderful, much-needed vacation.
Thank you, Chuck.
Send us
Great
some
job.
videos, okay?
Yes, sir.
Better work on your football picks in the meantime.
6-8. What were you this week?
Not very good.
6-8.
Okay, thank you, Harry.
Okay, see you, buddy. We'll be back in just a few minutes. Don't go away. Pretty please.